Welcome back to our channel, where we bring you valuable insights into personal finance and retirement planning, and specifically how this impacts on us as we plan for our early retirement. In today's video, we'll discuss the impact of rising mortgage rates with a special focus on early retirees and those needing retirement. As mortgage rates can significantly affect your financial situation, it's crucial to understand the potential implications and explore strategies to navigate this changing landscape. So let's dive in. Hello and welcome to our channel. We are Lizzie and Bob. We're in our 50s, we live in Glasgow, Scotland, and we're heading towards our goal of early retirement by making plans and being careful with our money. Retirement really does throw up so many questions, but hopefully we can break these areas down into manageable and sensible sections that will help us with our plans, choices and decisions. We hope you enjoy and come along with us on this journey. Now, before we explore how rising rates can impact on individuals nearing retirement, let's first establish a clear understanding of what mortgage rates are and how they fluctuate. Mortgage rates represent the interest charged by lenders for borrowing money to finance a home purchase. They are influenced by various factors including the economy, inflation, the Bank of England or the Federal Reserve's monetary policy, and also market demand. Over the past 2 years, mortgage rates have been on the rise, both in the UK and elsewhere, due to changes in economic conditions and central bank policies. Prior to that, they had remained historically low for a long time, but that has and is changing. So it's essential to be prepared for any potential increases in the future. Now that we've established a foundation, let's examine how rising mortgage rates can affect individuals who are planning to retire early. So early retirees often have a limited income source during retirement. With rising mortgage rates, monthly payments can increase, putting an extra strain on your budget. So it's crucial to be aware of this and to be ready to account for these potential changes when planning your retirement income. The average mortgage rate for a 2-year fixed deal has risen to 6.01%, and the average for a 5-year fixed deal has increased to 5.67% over the last little while. Whilst many people heading towards retirement will already have paid off or be close to paying off their mortgage, this is not always the case. For example, in our case, we took out our first mortgage, which was a 25-year mortgage, when we got married. After our first child was born, we needed a bit more space, so we sold our first home and then remortgaged for a bigger house, which cost us more money, and of course, to be able to afford that, we increased the amount we borrowed and extended the length of our mortgage period yet again. We remortgaged 2 more times after this for what we thought were good reasons, and of course, when you're young, 25 years seems like such a long way away. A recent article by the Resolution Foundation predicts that mortgage rates are expected to peak in January 2024 before starting to fall again. However, in the meantime, the average annual repayment mortgage is expected to increase by £2,900 per year for those having to renew their existing mortgage. So fast forward to 2023 and higher mortgage payments along with increased costs for utilities, food, etc. during this cost of living crisis period may leave less money available for saving and investing. This situation can obviously impact on your ability to achieve financial independence, as it limits the funds you can allocate towards retirement accounts and other investment vehicles. Rising mortgage rates may require early retirees to reevaluate their retirement timeline. It's important to consider whether it's feasible to retire early or if it would be more prudent to work longer to manage the increased financial obligations. So let's talk about our mortgage as an example. We are currently on a 10-year repayment mortgage, which was on a fixed rate of 2.34% for the first 5 years. This is coming to an end soon, and if we do nothing, our mortgage will automatically go on to the bank's current variable rate of 8.74%, which will result in a significant increase in our monthly mortgage payments of about £316 a month. So if, like us, you're approaching retirement, you also need to be mindful of the implications of rising mortgage rates if you still have a mortgage. So now let's explore some of the strategies to help you navigate the situation. First of all, you could consider refinancing your mortgage to secure a lower interest rate. By refinancing, you may be able to reduce your monthly payments, freeing up funds for other retirement-related expenses. In this case, that's not going to happen for us. We could remortgage for a new 2 or 5 year fixed rate, but it's still going to be more expensive than the current rate we are paying, and it would probably add about £134 a month to our monthly mortgage costs. So there isn't going to be spare money freed up to go into extra retirement related expenses. You could evaluate the possibility of downsizing your home or relocating to a more affordable area. This approach can help reduce your mortgage payment or eliminate it entirely, improving your retirement cash flow. However, this is not really an option for us at the moment because we like our home and its location, and house prices are quite high anyway, so the costs of selling and then trying to find somewhere else that we both like is just a stress we don't want or need right now. Given the potential impact of rising mortgage rates, it's crucial to maximise your retirement savings. So it's worthwhile considering if you can increase any contributions to your retirement account, such as your ISAs, your SIPs, etc., to build a more substantial nest egg. For us, we have been increasing our savings over the last few years, and we now have a decision to make. Do we try and pay off our remaining mortgage, so that's 5 years of our current mortgage, and become mortgage free, or do we refinance to another deal which is less than the variable rate but still more than what we are currently on? So in conclusion, as mortgage rates continue to fluctuate, it's essential for early retirees and those nearing retirement to stay informed and be proactive. Understanding the potential impact on your finances and exploring appropriate strategies can help you make more informed decisions to safeguard your retirement plans. It's worthwhile saying at this stage, if all this is new to you, you're not really sure what you should be doing, then it's worthwhile speaking to a professional, and a financial advisor should be able to put you on the right track. So that's it for today's video on navigating rising mortgage rates for early retirees and those nearing retirement. Thanks for watching and listening. We hope you found this information valuable, and if you are on a similar journey to us, or you want to find out what we end up doing with our mortgage, then please consider liking, subscribing and dinging that bell for future updates. In the meantime, it's onwards and upwards towards retirement for us. And if you want to hear about a retiree mortgage horror story, watch this video. Bye for now.